Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
The economy very much in focus. Investors awaiting the delayed September jobs report due out on Thursday. Torsten Slok of Apollo making the case for a rebound in the economy, writing Liberation Day was almost 8 months ago. Fiscal and monetary policy are easy, and easy financial conditions point to a re-acceleration. Torsten joins us now for more. Torsten, welcome back, sir. Are you expecting to see some of that in the September jobs data, or is that too early?
That is too early, because the risk, of course, is that in October we had the government shutdown. And, of course, the chance is that there therefore might be some weaker data for the month of potentially November also once we do get that. But I do expect that once we look into next year, we have still relatively easy financial conditions with, of course, the stock markets. Been some wobbles more recently, but still very supportive. IG spreads, high yield spreads, loan spreads, very supportive. You also at the same time have that you have tailwinds because Liberation Day is now 8 months ago. And finally, we also have general tailwinds because we are going into an election year, and therefore if we do get the $2,000 stimulus checks that you just talked about, that will certainly also be helpful. So in total, I do think that the market is too negative on the economic outlook and the risks are actually rising, that we may have some re-acceleration once we get into 2026.
Torsten, is that a re-acceleration that comes with jobs growth or not?
I do think that it will come with job growth. It is actually very impressive when we think about it, that over the last 8 months, think about what we've been through, the shocks that the U.S. economy has been facing, not only when it comes to, of course, trade war, also the shocks coming from immigration. And as you just mentioned, Jonathan, the non-farm payroll equilibrium is now down at 50,000. According to the Dallas Fed, is as low as 30,000. So therefore, the bar has been lowered. And therefore, I do think that if we get numbers that are in that range, then we should look at that and say, this is exactly where we should be. So in that sense, I do think that the economy has been remarkably resilient for the last 8 months. And I do think that as the trade war gets more and more behind us, I do think that a lot of the fog will be lifting.
Torsten, to Anne-Marie's point earlier, how important are the retail earnings this week? The Walmarts, the Targets, the Lowe's?
They are very important, and they do feed into the broader conversation about the K-shaped recovery. So it is still the case that higher income households continue to benefit from asset prices having been higher. And of course, also very importantly, because the level of yields is higher, that means that not only are high income households benefiting from asset prices going up, but they're also benefiting from the cash flow they get in fixed income is at the highest level in decades, both when it comes to public credit, but also private credit. So therefore, the tailwind to high income households continues to be strong. Lower income households have been suffering from interest rates going up. They have also been suffering from wage growth being weaker than what you see for high income households. But broadly speaking, again, with job growth still steady and stable, and again, the trade war uncertainty more and more behind us, and especially now, think about the one big beautiful bill. The CBO is estimating that will lift GDP growth next year by 0.9%. That's a very significant tailwind from fiscal policy. So all those things combined argue for the economy beginning to look better as we get into 2026.
And Torsten, conceivably, this could argue for the Fed not to cut rates and explains why there has been a more hawkish tilt to some of the communication that we've gotten from Fed officials recently. What do you think the consequences would be if the Fed cuts by another 50 to 75 basis points by mid-year next year?
Oh, that would be very serious, because think about it. We already have an outlook. If I type ECFC Go on my Bloomberg screen and look at the quarterly profile, it is already the case that the consensus expects inflation to be 3% for the next 18 months, while at the same time growth is slowing down. So to your point here, Lisa, if we now see that growth is actually not slowing down, and we already have inflation at 3% in a slowdown scenario, the risk is, of course, that inflation could be even higher than 3%. So cutting into that would, of course, be a major mistake. So I do think that the risks are rising, that we are again underestimating that inflation has a lot more tailwind over the next several quarters.
With that as a potential backdrop, what would it mean then if the government gave everyone $2,000?
That, of course, would provide even more fuel here to the economy. So if we already have the one big beautiful bill lifting GDP by almost a full percentage point, we have trade war uncertainty beginning to be more behind us. If we still have stock prices, we are discussing the AI bubble, all of us, very intensely at the moment. But given that there's still tailwind in the stock market that's supporting, of course, high-end consumer households in particular, all those things combined, they definitely argue that if you send out $2,000 checks, then you just run the risk that you will overheat the economy even more.
Torsten, then we're introducing a new Fed chair on top of all of this as well in May of next year. And I just wonder, Torsten, how difficult it is right now to offer any kind of outlook on Fed policy for next year, including that second half of next year, which includes that new Fed chair.
That's right, Jonathan, and that's exactly why I think that the FOMC members are really coming out with quite strong voices at the moment. Lori Logan, first of all, saying that she did vote for the cut, and then subsequently saying, well, I didn't really want a cut. And now also on Friday, it really begins to emphasize more that, well, we still need to get inflation under control. And whereas you have, of course, other FOMC members, Steve Moran in particular, of course, saying that we should be cutting sooner rather than later, the dots are really moving in very opposite directions here, and it's becoming much more outspoken from the FOMC members what exactly that their views are, because this debate, to your point, Jonathan, is really still very, very early, in particular when you have these very strong opinions about what are the tailwinds and what are the headwinds at the moment.
Torsten, do you think this is a new era for the Federal Reserve, where we're going to see greater dispersion, at least publicly, from policymaker to policymaker, and ultimately, what do you think the consequences are for financial markets?
I think it is a new era because we do get, by definition, of course, a new Fed chair in May of next year, because that's when Jay Powell has to step down. And then we will, of course, figure out if that Fed chair, of course, is going to take the same view as Steve Moran, or if that Fed chair is going to have the view of Lori Logan. And if the risk is, of course, that Fed chair comes in and then begins to say, well, interest rates could begin to go down because maybe the economy can handle lower rates, then, of course, the fear could be that inflation is going to be higher. So the debate, exactly to your point, Jonathan, here around what should we put weight on, especially on the dual mandate. Should we put weight on inflation still being at 3%? Should we put weight on Challenger Gray and Christmas showing that there are maybe a bit more announced job cuts? I mean, this is still a very, very important debate, and we will not know the answers to this before we get into January. Remember also the non-farm payroll numbers for November are normally collected in the month, the week of the 12th, and in the month of November, the week of the 12th was last week. So that means that we get closer to Thanksgiving. That means that even there may be some distortions on the data for November. Yeah. So that means that we may get all the way into next year before we really have a better handle at how strong is the U.S. labor market. So that's why we still have a fairly foggy situation for the next several months.
Stay with us. More Bloomberg surveillance coming up after this. Stocks inching higher ahead of key earnings from Nvidia. Sarah Hunt of Alpine Saxon Woods writing, earnings estimates still seem to be faring well. And absent any bad news from Nvidia, markets could stay on track for a positive end to the year. Sarah joins us now for more. Sarah, good morning.
Good morning.
What are the lessons from the recent volatility, if there are any lessons at all?
I think that there was a whole lot of things that were going on that created some of that downdraft. And I think, there was an earlier question about what's the most important thing that's coming up this week. I think it's a question of timing. If the payrolls was coming before NVIDIA, I'd say payrolls. But because NVIDIA is coming first, that's going to set a tone. And either payrolls are going to help that or hurt that. And I think that, if you get any more downdraft in technology, it's going to be hard to rally through the end of the year because there is some concern there and there's some concerns about valuation.
We've been speaking for years about the K-shaped economy. This week's the K-shaped market. Consumers been struggling. You've seen that in some of the restaurant earnings. We're going to see it in the retailers potentially later this week. And then there's Nvidia. Can we close that K anytime soon in the equity market? Never mind the economy.
It's a bit tough because people are, if the technology story stays on track, people stay away from some of the retail areas where you've seen weakness. If there's a wobble, then people start looking at staples. Like you saw that downdraft day, there was some of the stocks that were doing okay were the more value-oriented, more dividend-oriented, more like those kind of stocks did better. I think there's an argument to be made that going into next year with valuations where they are, there should definitely be a balance in the portfolio, and you should have some of that because if you get volatility, that's going to act better than some of the technology. And I think the volatility is just going to stay and get moved around from data point to data point.
Is Nvidia the last tech company to actually feel the pain if AI isn't delivering on some of the promise that people expect?
Well, it's interesting to see the number of people who are, going publicly talking about getting out of their Nvidia stakes. And I'm not sure if that's one of those, we want to move on to the next thing, or we think that's the top for Nvidia. I think Nvidia is in a good spot in terms of being able to keep bringing money in because people still need these chips. There is, to your point earlier, also a big depreciation cycle on those chips. So there is a round robin. It's not like you buy it once and you don't have to buy them again. So I don't know that Nvidia is going to be the problem there. I think the issue is going to be who's making money with those chips and how is that return coming, because that is the big question into the next iteration of AI.
This is the reason why Oracle has been so interesting, why OpenAI has been so interesting, why the CDS spreads and how much they've been blowing out has been so interesting, because there is a question about whether the rank and file company in the average economy is seeing the monetization from some of the new AI tools that they've been getting and whether that's enough to justify the massive spending and investment. Is anything that you're seeing seeming to suggest that, yes, we are getting to a place where we will see massive sea change kinds of earnings from the rank and file companies that could lead to that broadening out and a justification for AI valuations?
I think the hard thing is that to believe that that is going to be the case in the near term, it has to be about, to some degree, productivity, which has to be about not having as many people on the payrolls. And that's not a great thing right now because we don't want to see that happen. I don't know that we are yet understanding exactly how those tools are going to play into a variety of things, including productivity and better earnings, except to get rid of people. And so I think that you need to see some work cases where it's very clear that this is less about getting rid of people and more about making them more productive. And I think that's still not quite clear enough from the investment side to say, oh, I can see this going into this industry and that industry and that industry. That's what people are hoping for. I don't know that we're there yet.
Well, Lisa mentioned this earlier about how some Fed members are talking about the structural changes in the economy, like immigration, like these technology changes, which is why potentially there are shifts in the labor market. How does the Fed address that?
That's another question that having a whole bunch of 6 weeks of not having data does not help you at all, because that is trying to figure out what the right number is, to Torsten Slok's point, given all the things that are going on, is very difficult when you don't have enough data. You don't see weekly claims either, which also sort of informs you, even if it's not that week, the average of that starts to inform you. I think that's going to be one of the things that into 2026, if you need to see some earnings growth because that's what's being built in, but you also need to see a labor market that people feel comfortable with. And I think that we just don't have enough information right now. And that's where the timing of that data coming in versus other things starts to be an issue. And the faster we get some of it, the better off we are. But it's going to be about what's happening now. I don't know that September is that informative because people were looking at the ADP numbers for October.
Two pillars coming out this week in terms of Wall Street for Nvidia earnings and then Main Street for when it comes to Walmart. Could Wall Street continue to do well if the consumer's really struggling?
It's managed to do it so far this year, and the consumer has been struggling for a while, especially on the lower end. I mean, you've seen some of that delinquencies on the lower end in auto loans, delinquencies on the lower end in credit cards, but not on the upper end. That upper end spend has really been able to carry things, not so much for the retail sector, because as a whole, they need more than just the upper end, except the very high luxury stuff. So it depends on where that goes, and that's also where the labor market comes into play, because if you feel comfortable that you're keeping your job, it's easier to spend the money as it comes in. But if you don't, that's where people start to get a little bit more on the savings side.
Stay with us. More Bloomberg surveillance coming up after this. We've heard this. It's been building for a while. The push against Russia, the push against countries, economies doing business with them, notably China, India. Who else does this apply to?
Well, I think really it's about China and India, because this is going to really force China to either have to go around some of the sanctions or deal the blow from the United States at the same time that the Treasury Secretary over the weekend talked about the fact that they don't have the final agreement in ink fully in place, and they expect that to happen by Thanksgiving. Is this now another point of leverage Washington is trying to use?
And joining us now is Terry Haines of Pangaea Policy. Terry, welcome to the program. What is the president's big effort around Russia all about? And will he actually follow through?
Good morning, all. I'm on Team Anne-Marie this morning to pick up on that point about leverage. This is about a lot of things, but one thing it is exactly about that. What you can read between the lines from Secretary Bessent yesterday in a long interview is that the supposed current deal that's happening between the United States and China is now taking a lot longer to paper than was widely thought, even that Bessent had said. So it's about that. It's about pushing India, I think, on getting a trade deal done. Secondly, thirdly, I think it's about pushing the Europeans on getting serious on Russia as well. The president has long said that the United States policy only works well if the Europeans are willing to pull equal weight here, and Europeans have been tap dancing on core questions around Russia and frozen Russian assets for years, literally. And either they're going to get serious or the Ukraine thing is going to drag on for even longer.
Terry, the administration is going to use this leverage as part of the destination. But when we get to the final destination, do you think Congress will end up passing this bill?
I think they can, sure. The willingness exists, the votes exist. This is a lot more up to what the president wants to do in terms of how he wants to use that particular pressure point. One thing I saw in Trump's impromptu remarks there, frankly, was an ability to take the thing off and put it back, take the thing off the back burner and put it on the front burner. Russia may dismiss that, but I think they probably dismiss that at their peril, considering that the president has the ability, thanks to Congress, to actually get this thing done if he chooses.
The Treasury Secretary seems to be throwing cold water on a Wall Street Journal report that says China is trying to ratchet back rare earth minerals that go to companies that help the U.S. military. Do you think China will amend that, or is this something that they're going to stick with?
I think the track record here is that China has been, I think Bessent referred to April 6th in that interview as being the date in which the hijinks started on rare earths. I think they've been doing this for 6 or 7 months. I think the base case has to be that they'll continue to do it. So what from a market's perspective, you have to take that into account. You also have to take into account that the United States is going to continue to redouble every effort it can to get rare earths and start rare earths that are not of Chinese origin.
Terry, how much of a conflict is there between trying to get leverage in some of these trade talks and trying to get cost of living gains for the United States and for average consumers, given the fact that that seems to be a renewed push by the president? Is there a conflict here?
I think there's an order of precedence here, and the order of precedence from the administration's point of view is that they need to get the trade deals done as many and as much as possible, and move forward from there. And they will. They tend to put their stake out kind of far and in a pure sense and work back and cut back as they need to. And I think that's a lot of what you saw with the foodstuffs tariffs last weekend or last week. Bessent talked about this as being mostly a matter of existing trade deals coming or new trade deals coming into force. I don't think that's quite the case. It's part of the case. But what they'll continue to do is continue to work on the trade deals with the idea that they can calibrate them pretty much in real time as they need to.
Terry, just to circle back, full circle to the beginning of the conversation, how much can this administration go really hard on China with sanctions on oil if it raises gasoline prices in the United States at a time where there's a real cost of living focus?
I think the priority for the administration, there's a balance here, but the priority for the administration is going to be making sure that China understands that it will use the leverage of it that the United States has, and that's certainly a big part of it. I think the president cares a lot about gasoline prices, but one reason why he talks up so much the price of gasoline coming down, frankly, I think is he wants to buy himself some wiggle room with the public to make sure that if he ends up having to drop a dime on China on oil, that people understand the what's and whys.
Stay with us. More Bloomberg surveillance coming up after this. Profitability of the AI narrative whipsawing tech stocks as valuation concerns rise. JPMorgan's 2026 global investments outlook remaining bullish, writing artificial intelligence remains the defining force in financial markets. Stephen Parker, the co-head of global investment strategy at JPMorgan Private Bank, joins us now for more. Stephen, good morning. Good to see you.
Good to see you.
Should we talk about the three bogeymen?
Let's do.
Overcapacity, leverage, valuations. Your words. How concerned should we be into next year?
Yeah, look, we think that there's still a long way to run in this AI trade. If you look back since the launch of ChatGPT, 75% of the returns, 80% of the earnings, and 90% of the capital spending growth of the S&P has been driven by AI-related companies. And so the question now is, are we facing a bubble? And as you said, it's really those three factors. It's overcapacity, it's leverage in the system, and it's valuations that we need to focus on. And we think that we're still in the early stages of this story.
How much do you think that the extra editions of this story, the extra chapters, really will come from a Fed rate policy or fiscal policy or some sort of more accommodative backdrop that can allow valuations to get even more heady?
Yeah, look, I think we're in a world where there is still a lot of capital that is looking for a home. Investors are willing to make investments, but importantly, what we're seeing now is that these investments in AI don't look speculative like bubbles of the past. If you go back to the dot-com era, in the late 90s, there was 40 million miles of fiber that were laid to help support the internet. And by mid-2001, only about 1% of that was being used. It was supply in search of demand. AI, the story is reversed. The vacancy rates in data centers today is at an all-time low, 1.5%. And 3/4 of the demand for new construction in data centers is already pre-leased. So we're not seeing those signs of speculation, particularly from a capacity perspective, that gets us nervous.
So your base case for next year is 7,200 to 7,400 in the S&P 500. Your bull case is 8,000 to 8,200. What makes you either constructive or uber bullish?
Yeah, I think it all comes down to earnings. And we've seen a tremendous run of successful earnings results. 5 of the last 6 quarters, we've seen double-digit S&P earnings growth, despite the fact that we've had policy uncertainty, economic uncertainty, trade uncertainty. There's perhaps never been a bigger disconnect between the stock market, particularly large cap stocks, and the broader economy. We think that continues, and we see another year of double-digit earnings growth, which is going to support that upside that you talked about.
How do you think about all of this in an age when globalization is out of fashion?
Yeah, I mean, we're launching today our new 2026 market outlook, Promise and Pressure. And one of the key themes is this idea of global fragmentation. So post the Cold War, we were in a multi-decade period where it was all about globalization, cost control, efficient supply chains. That kept inflation down. It kept margins up. Increasingly over the last couple of years, as a result of the pandemic, conflict in Europe, trade policy, we're now in a world where countries are looking in. They're more focused on security and reliability, both in terms of defense, but also of supply chains and infrastructure, and that has ramifications.
US versus China, that's what this feels like. Where does Europe fit in the US versus China?
So Europe is an interesting sort of pivot point in the global landscape. When we looked this year, the announcements that we saw out of Germany in terms of the shift in fiscal spend, the willingness to embrace positive fiscal impetus is a huge change. One of the key themes when we talk about this idea of increasing fragmentation and a focus on security is what's going on in Europe as it relates to the spending on their infrastructure and their defense. We think that's both an important macro trend, but also an investable opportunity.
I think people have the sense they know how to play the US story if they want to play it. I think they feel comfortable playing the China story if they want to play it. After the first half of this year, I think they're sitting here looking at Europe into 26 and thinking, well, maybe that was the trade. That was just sort of like last year and now we're done with it and we should move on to other things. What is the trade in 26?
We still think there's opportunities in Europe. One, a lot of the fiscal policy that was announced this year isn't actually going to be put into place until next year. So there is a growth dynamic there. And in fact, we think from an economic perspective, we're probably going to see a convergence, meaning that a smaller discount of growth in places like Germany versus the US. But when you think about how you want to play the story, we continue to think that the European defense names are probably the most interesting opportunity that we're seeing.
Based on the framework that you just laid out, how are you looking at diversification? Is it from a regional basis or is it from an asset class basis?
Yeah, so we talked about the outlook, we talked about AI, we talked about increasing global fragmentation. The third theme that we think is really going to drive markets in the years to come is inflation. And these factors that we talked about, increasing fragmentation, increasing fiscal policy, means that inflation is likely to be more volatile and the floor is likely to be higher. And so when you think about building portfolios, the playbook of the past has to evolve. Stocks and bonds on their own are not going to be enough. Stocks can help you when you get recession fears and growth scares, but increasingly in a world where inflation is going to be part of the narrative, you need to look at things like infrastructure, real assets, and gold, not just on a tactical basis, but on a more strategic basis.
So sticking with the gold trade, even after the big boom over the last year?
We are. We continue to see upside. We think we can get over $5,000 an ounce on gold, and that has to do a lot both with some of these concerns around geopolitical issues, the concerns around the dollar, but most importantly, and from a sticky perspective, central banks around the world are continuing to realize that they need to diversify, and a lot of these central banks are still underexposed to the long-term targets that they're trying to achieve, which means more demand in a supply-constrained world.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.